On the podcast with us today is Joel Florek. Joel, welcome to the podcast.
Hey, thank you very much, Dan. Happy to be here.
Awesome. Well, I'm looking forward to diving into this project that you have called Chesterton Townhomes. It's located in Chesterton, Indiana, 15 units. Used to be 16. I'm sure we'll get into that, but it's a 15-unit acquisition for your group located within the Chicago MSA. Just about a 45, 50-minute short drive to downtown Chicago, built in the 99 to 2000 range. But before we dive into that property, Joel, I want you to give the listeners a little bit of a background about who you are and where you are right now in this multifamily space.
Yeah, thanks, Dan. I started out investing in 2015. After I graduated from college, I house hacked a 4-unit, lived in 1 unit, rented out the others, worked on renovations myself when I'd get done with work. Work late at night, painting and remodeling, doing all that kind of stuff, the nuts and bolts. Got a chance to kind of creatively finance a 16-unit. Put $5,000 down to purchase a $685,000 16-unit property, which has been a phenomenal cash cow for me over the last 4 years. And after that, I acquired 2 additional properties, both using additional creative finance structures, low money down stuff. And, basically built up a portfolio of 31 units and quit my, kind of day job about 2.5 years ago, been full-time for the last 2 years now, just managing my own portfolio, doing my own property management. I take on a lot of capital improvement projects myself. And when it came to planning out my 2019 goals, I really decided, hey, where do I want to take my business? Do I just want to keep creatively financing deals as I can either refi or find, extremely motivated sellers, distressed properties, ultimately knowing that I'm going to be limited in the size and scale of assets that I can purchase? Or do I want to scale up to larger assets? When I looked at my long-term goal, I knew that I wanted to be in assets with on-site property management. I wanted to get myself out of the day-to-day property management and repairs, which inevitably I've been in, which has worked out great for me. Don't get me wrong. Sweat equity has been how I've gotten to where I am today. But I want to get, I want to get out of that. I want to scale up and get into larger assets. So as I looked at what options were available, syndication really seemed like it was kind of the preferred model that ultimately made sense. And there's enough people that are out there in the industry who are doing it where I'm not going to be the first person going out and kind of promoting this new way to, go buy larger properties than I could myself. So it's something that people are generally comfortable with. They understand, those folks who are sophisticated and wealthier individuals that have been successful either in growing their own businesses or what have you. So 2019 has been all about, partnering with other folks, networking in the industry, building out my investor list. Ultimately lost out on a couple best in finals for some larger deals that I was pretty excited about earlier in the year, but that's okay. It happens. I got to stick to your numbers. And this deal in Chesterton came up. It's close to home. It's a great little community, a part of the Chicago MSA. There's a great story behind it. And ultimately the numbers speak for themselves. So I decided to move forward on that, give my investors who are interested in working with me the opportunity to get involved, start writing some checks, be able to start getting those returns, benefit in the upside, and put both myself and them in a position where we're all going to be more comfortable working together on a larger deal here in the future. So actively working to underwrite a number of larger deals. Also partnered up with another operator on a 107-unit deal down in Louisville earlier in the summer. That closed up. So have some kind of exciting things that are moving forward, and just looking to continue to scale up and partner up with folks to be able to all achieve our, financial and lifestyle goals that we believe real estate's going to be able to help us achieve.
That's awesome. Well, let's dive into this one, the one that's the Chesterton Townhomes there in the Chicago MSA, 15 units. Talk to us first a little bit about how you actually found this deal.
So this deal came from a broker who I had lost out on a best and final with. He had another listing. So I've been actively talking with him since the beginning of 2019. Like I said, we got close, but ultimately got beat out by another buyer. I was actually on my way to a meetup with you that you were hosting in Chicago, and the broker gave me a call, presented this deal to me, said it was a new listing. He sent me the OM. I'll be honest, at first I kind of wrote it off as not interested. It's a much higher price per unit than what I've been used to. Been used to buying stuff at 30, 40,000 a door. And, this was in the, $80,000 a door range. So, just by that kind of, off the cuff rule of thumb, I was like, yeah, nope, probably not something I'm interested, but I'll take a look at the OM. Limiting belief, right? Units are typically priced higher for a reason, whether they get higher rents, whether they have lower expense ratios, whether they're a higher quality asset, whether it's in a better community, number of different reasons, right? Ultimately dove into the OM, underwrote my own numbers, and felt, pretty confident that if they could come down a little bit in price, then we'd be able to play ball.
So how many rounds of offers did you actually go back and forth with the broker on this one and the seller?
I think it was only maybe 2 or 3 back and forth. I think I initially came in at 1.2. They were asking 1.315.
Mm-hmm.
And came in at 1.2. I think they came down to 1.28, and I came up to 1.265, and we closed it. It was all pretty quick. Other than my initial LOI, the rest of it was all verbal back and forth with the broker till we hit a number that we liked, and then we wrote up a formal contract.
How many other people do you feel were probably bidding on this property with you?
There were, in speaking with the broker, he was only about 3 weeks into the marketing process. So there were a number of different offers that came in the 1.1 to 1.2 range. No one was really willing to come up into the higher 1.2 range. But given how, hands-on I've been with my own portfolio, knowing kind of the true costs of what I can drive down some maintenance or repairs or CapEx projects to, rather than having to hire them out. I was pretty confident that we could knock out a couple projects for, much lower cost. And then I also got an opportunity to tour some additional comps in the area, particularly a larger 100-unit asset that had just popped up for sale. I'd been, it's a broker that I'm actively in touch with, and toured that property. So got a chance to see those units, look at the sale or the comps for rents, and was really surprised at how low the rents were for this 15 unit.
And on the offering going back and forth, did you have to put any earnest money deposit down or anything?
Yeah, it was, once we got it under contract, it was $20,000 down. I didn't have to do that hard, smaller asset. So, didn't necessarily have to play that game that you're typically seeing in some of the more competitive markets. Yeah, $20,000 down. We did 75 days to close, and then I had an option for 2 15-day extensions. Didn't need those. Could have closed earlier, but we had our 75-day, date on the calendar. So just decided to keep everybody on the same schedule. No reason to shuffle it around, and closed on time. And honestly, the closing process was really easy through due diligence on this asset.
So when you were negotiating back and forth on the closing timeline and the other terms, was there any additional negotiating that you had to go through with the broker and the seller to kind of tighten that up, or was it more just they were more concerned with the amount?
They were primarily concerned about the amount. Ultimately, I asked the broker, what are the expectations for closing period, for earnest money? He provided the terms. I didn't have a problem with it. Generally, the way I feel is that as a buyer, I want to make the broker's job as easy as possible. And I want the seller to feel like everything's going along smoothly so that, hopefully I can build a good reputation. So if I don't have an issue with the terms, I'm typically not going to negotiate them, just to try and get, a little bit less earnest money. Like, no, I'm serious about this property. I'm moving forward. Who cares if it's $15,000 or $20,000? It's all going to, come back at the end anyways. And it wasn't hard. So that there wasn't any concerns there.
So when the broker called you and told you about this asset coming online and available for purchase, did you already know about the asset, and had you already seen it before, or is this the kind of the first time you'd even heard about this particular asset?
I didn't know about this particular property. I already knew about that 100-unit asset in Chesterton. I had actually just toured it earlier in the week. So I had a fresh understanding of what the rent comps were in the area, had already shopped a number of the other larger complexes. So when I saw this asset and, did, quick half hour of additional research, I knew pretty quickly that there was definitely some pretty strong room for upside on the rents.
And at what point did you tour the property?
I scheduled a tour pretty much right away. So it was as soon as I got a chance to spend about a half hour diving into the OM, based on my knowledge in the market, I told the broker, hey, next date you have to be able to get the seller and you down there to get a tour. Let's make it happen, and I'll adjust my schedule accordingly. So I think we got a tour within the next week, and
okay.
I had an offer, I think later that day.
After
the
it?
Tour. Yeah.
Yeah.
I usually always know my numbers going into a tour. So.
Yeah. So you mentioned the due diligence process going pretty smoothly on this acquisition. Were there any issues that came up that you had to address?
The biggest issue that came up was the seller was unwilling to provide any sort of portion of tax returns specific to this asset. They didn't have any sort of audited financials that they were willing to provide. Of course they had, their CPA prepare everything, but they weren't willing to have anyone, sign off on any of that, which caused a little bit of a challenge with the bank, with the appraiser at first. And we had a little bit of an issue going back and forth, just trying to get them to disclose a little bit. Our assumption is we knew that they were collecting some rents in cash from a few of the tenants. So they weren't reporting as much income. Ultimately, we ended up getting them to disclose their basically the form on their tax return related to the expenses. So they blacked out a bunch of sections, and they were pretty unhappy about that. But ultimately, our bank and appraiser needed that to be able to finish up their work.
Sure. So let's dive into that as well, about the finance on this asset. What did you do from a finance perspective?
Ended up going with a local bank in the region. They financed it 80% LTV, 20-year amortization, 5-year balloon. 4.52 is where we ended up coming in at. No prepayment penalty, and no prepayment penalty if as long as I refi with them.
Mm-hmm.
So, but if I refi out and go to another bank, we've got to step down.
And did you, when you were finding this lender, is this one that you had used before, or is this one that you kind of had a broker actually go out and try to shop around various different local banks or credit unions or private lending options in the city?
I reached out to a couple mortgage brokers to kind of get their thoughts and have them provide some guidance on what they likely would be able to do. When they came back and told me what terms they would expect to be able to get and the cost, I said, thanks, but no thanks. I'll go out and shop this myself. I've had some good experience financing assets of this size and type before. So I ended up going out to, I think about typically my process is I always go out to about a dozen different banks schedule calls with the mortgage officer, on the commercial side of the bank. And I just run through the deal really quick in 30 seconds to a minute and say, hey, here's the deal. Here's what I'm looking for terms. Is this something that your bank might be interested in working with me on? And they'll typically tell me yes, no. And I narrowed that down to, I think, 4 different banks, and then ultimately had those banks go through the underwriting process to provide me terms. So once I got all my term sheets in, this bank ended up being the most competitive.
And are those conversations usually done in person, or are you doing those over the phone with those banks when you're shopping them?
Yeah, starting out all over the phone.
Yeah.
It would take way too much time to schedule meetings and go drive out. I, make all those calls typically within a couple hours. Of course, you don't always get them on the phone right away. So it kind of takes about a day before you get them on the phone and have that initial conversation. But once I narrow it down, then I always make a point to try and meet those bankers in person. And anytime they give me kind of we'd be interested in taking a look, I have a full packet of information ready to go. I have my underwriting. I have kind of a brief business plan that I've already put together on the asset, provide details on, all of my past properties that I've done, tax returns. Sometimes, I end up having to do it in a couple different emails because there's so many files that I'm sending over. Ultimately, what's great is I typically end up having bankers say that, this is the most information they've ever received from somebody who's looking to apply for a loan for a, multifamily asset. So it puts me in a good position where I become very reputable with the bank right away, even if it's a new relationship. This bank ended up being a recommendation from another investor who I'm connected with in the area. And he actually ended up becoming an investor in this deal as well. So I think that definitely helped us get better terms with this bank because of the personal connection and the relationship that had existed there between my investor and that bank with the deals they've done.
At what point during the timeline of this acquisition, or in most of your acquisitions, are you actually doing that step of vetting and trying to, not only vetting, but really trying to really nail down the lender?
Yeah, typically before I put in my LOI, I'm having those initial conversations to understand what terms are realistic for me in my underwriting for this deal. I typically I'm not sending them all the packet. Like I say, I'm just having kind of those brief conversations, get some ideas on terms, make sure that I'm conservative enough in my underwriting, submit my LOI. Once we have it under contract, then I go ahead and I get banks actually running through and putting together term sheets, because now I actually have a contract. It's worth their time to be to go through the underwriting process and provide me a term sheet. It's also worth my time to go ahead and have a half dozen different banks go ahead and underwrite this deal for me.
So let's move to a different topic here about how you kind of structure this deal for yourself and your investors, and kind of walk me through that process.
Yeah. So ultimately, the way we ended up structuring this deal is kind of your typical 70-30 split. However, the caveat there is that we included the option for basically the general partners to buy out the limited partner shares after 36 months at an 18% IRR valuation. So that way, we're going to be able to provide cash flows on a monthly basis here for our investors over the next 3 years. And then after 3 years, the plan is to refi this asset and be able to basically pay back the investors' initial capital and any additional returns necessary for us to hit an 18% IRR. At that point, the investors will be fully out of the deal. And myself and my brother, who has a small percentage in the general partnership, who will end up taking over full control over the asset.
I've actually been seeing some of those structures lately where they're really kind of like a mezz debt or kind of acting like mezz debt on top of the current financing, where after a certain period of time, then you can achieve a certain return IRR hurdle, annualized return hurdle, whatever you want to put in place there, that is actually happening. It's very, very interesting and very unique, to kind of see that happening. It's nothing new, but I mean, it's definitely, different than a typical syndication where they're always participating in the upside and then going with you on to the next deal and various things like that. So it's kind of unique. How was the conversations with investors about that piece of it? Or, because obviously, it depends on who you're talking to. And if it's a newer investor that's not really familiar with these types of investments, it might not even raise a question or an eyebrow for them. So what was that conversation like when you had it with those investors about that kind of a buyout process versus going on with you?
Yeah, most of the investors were totally fine with it. Some of the investors, definitely said that they would prefer to be able to, fully participate in the upside of the asset, to not, they'd like to participate in the long-term hold of the asset as well. However, a 20% average annual return, 18% IRR, over a 3-year hold period certainly is a pretty good deal for somebody who's, basically writing a check and not having to, do any of the work associated with, owning and managing a multifamily asset. So ultimately, for the investors, they looked at it and, kind of the discussion was always, it's still a very good deal for the investor. And for myself, it ends up potentially being a phenomenal deal, which means that I am very clearly incentivized to execute the business plan, and make sure that, that I get my investors the returns that I've promised, because this is my first syndication as well. So because it's the first syndication that I'm sponsoring, ultimately a little more challenging to get people to write checks for the first time. A lot of people say never invest in someone's first syndication. So for my investors, we had $280,000 total that we needed to close on this deal. I put $100,000 of that in myself. And then my investors brought in the other $180,000. We had 12 investors total. So everyone wrote pretty small checks, ranging from small as $5 up to $30,000.
And how many investors did you say you had?
12.
12. That is very interesting, that structure and that setup. I kind of, I think it's one of those things where lowering the minimum probably helps you as well. If you had had people down to 5,000 to 30,000, kind of could get their feet wet, especially with your first one in the very beginning. And, I don't see that a lot, but I like that strategy. And I like that idea to be able to see coming down off of the initial equity and, the minimum a little bit for somebody to, like I said, get their feet wet and kind of get used to investing with you. And, they like to see the returns and go on to that next deal. And that'll be great. So right now you acquired this thing for $1.265 million. What's your projection for the refi in 3 years?
Yeah, so the projection, I'm just pulling up my spreadsheet here, is that our appraisal should come in around 1.6. 1.64 specifically is where we're hoping for the refi. And that's kind of the other thing I guess I will note with this strategy is, unlike a sale, where generally you're going to have to sell at a discount to your appraisal, and you're typically going to have much higher costs, your brokerage fees, you might have fees for getting out of your loan early, you might have some additional legal costs. Because we're going with a refi, we avoid having to have the discount, have the extra fees. We just have a new appraisal, some legal paperwork, minimal, probably $7,500 in refi costs with our bank to be able to get this done. So it allows us to be more comfortable in executing the returns for our investors, as opposed to having to go through kind of the risk of the sales strategy.
And when you're doing a let me back up for just a minute, because obviously we're talking about the refis and things like that, and the projections 3 years down the road. Talk to us a little bit about how that's going to happen, because obviously, in the green room, we talked a little bit about where the delta was, and, from where you're trying to move the rents and stuff. So talk to us about where the rents are right now and what you're planning to do with the property from a CapEx standpoint. And then also, what's the plan to be able to move those rents?
Yeah. So average rents are 820 right now. They're all 2 bedroom, 1.5 bath units, 2 story in unit laundry, 1,230 square feet. Have a deck off the back. Everyone can park in, right in front of their unit. Um, the projection for rents, average rents after 3 years is 1,050. We actually just signed a lease for one of the units at 995. That's no unit renovation. So the plan here is that the units are in good enough condition where we'll just be able to basically keep them in as-is condition, normal unit turns. You're going to have to change some flooring. You have to do a little painting. You might have to switch out an appliance or two, but we're not planning on doing any specific upgrade renovation projects. The exteriors looked a little tired, needs power washing. The landscaping was really tired, inconsistent. So we actually just completed a landscaping project, cleaning up all the front beds, river rock, nice plants, enclosing the storage areas under the back decks with privacy fences. Great storage area, nice amenity that you can't get if you rent in kind of a big box apartment complex. It's one of the benefits of living in an asset like this. So just some minor little things. So we spent about $5,000 in exterior landscaping type projects, and then unit turns are just going to be normal unit turns. And based on where we're at right now with our new lease up at 995, very confident that over the 3-year hold period, we're going to be able to get those rents to 1,050 average.
Now, have you had any pushback on your rent bumps from the existing residents that are there?
We have not sent out those rental increases yet. That's actually going to happen here in a couple weeks for renewals. That'll be for December 1st. That those renewals will start to come into play. We're not going to bump them up to 1,050 right away. So it'll be anywhere from a $50 to $75 rent bump here year one. One of the things I have decided that we're going to go ahead and do is we're going to actually take over lawn care. Previously, tenants were responsible for that themselves, but we ended up finding out that 10 of the 15 units were paying for a neighborhood lawn care provider to actually come and mow all their lawns anyways. So we are going to include that in the rent now. We're going to be able to get it at a discounted rate from what the tenants are paying. And so at least this first year, they're seeing that, hey, things look nicer around the outside of the property. It looks a lot cleaner when I walk up to my unit. I'm a little more proud to say that this is my house. And then, oh, by the way, I'm getting a rental increase, but I'm not having to pay this cost right now anymore, which will be nice. So for this first year, hoping that kind of the combination of those two things will minimize the pushback against those rental increases. The other thing to mention here is that the previous owners, they actually almost bragged about a little, but they had only raised rent on one tenant one time in the 20 years that they owned the property. And there's still a tenant who's living there from 1999 when the first unit finished. So kind of gives you an idea there that, yeah, the people probably know that they've had it pretty nice from the standpoint of not having to deal with any rental increases. But we're going to go in and, kind of the combination of things to try and help alleviate some of that this first year. We're inevitably going to have a little bit of turnover. You have natural turnover anyways. So, ultimately that kind of $50 to $75 bump each year over the next 3 years will be able to get people close to that number. And we'll end up having some leases that'll, be over that average number.
Sure. Now, obviously, I'm sure people who are listening right now are thinking, you just mentioned these being in the Chicago MSA and rent control and all that kind of stuff. Obviously, this is in Indiana, so it's not necessarily inside of Chicago, but what's your thoughts beyond that with this asset, and does it actually apply to this one as far as, being able to push those rents like you're trying to do?
Yeah. I mean, Indiana, You don't have to deal with any of the rules, regulations of Chicago. What's been happening is because of a lot of the financial issues that the city of Chicago, the state of Illinois, and then the surrounding suburbs have had over, I'll just say that, the past decades of kind of leading into where they are now. You've had property taxes going through the roof. You've got higher sales taxes. Ultimately, you've had a degradation in a lot of the school systems. So you're seeing a lot of people choose to live in Northwest Indiana, but work in Chicago. So work in those higher paying jobs, but be able to live in a smaller town that has a better school district and fiscally responsible cities, and arguably one of the most fiscally responsible states in the country. So with that said, Chesterton in particular, but Valparaiso, Porter, Maryville, all these additional kind of cities in this surrounding area of Northwest Indiana have all seen this very consistent growth over the past decades. And we've also seen growth in employment and jobs. What ultimately that means, anywhere, is there's higher demand, right? So in Chesterton in particular, new construction 2-bedroom apartments start at $1,400 and go up to $1,800 a month. So just putting that in perspective, right now, our 2-bedroom units of comparable size with some better neighborhood amenities, you get to feel like you're actually renting a house instead of living in a giant apartment complex. We're down at $820 right now. So bumping that up to about $1,000, $1,050 over the next 3 years, we're still going to be an average of $500 a month below what the kind of Class A 2-bedroom units are going to be in the area.
Mm-hmm. Okay. Now I'm going to kind of go into these two, I like to call them my final 2 questions that I have for each one of our guests that come on. And they're kind of contrasting questions. Mm-hmm. The first one is really about what you found was easier during this entire process of this acquisition that you maybe in the beginning thought was going to be a little bit more difficult.
Chesterton's a smaller community, about 14,000 people. So I've actually been very surprised at the level of interest in this unit as we've marketed out the first unit that was vacant. And now we've got another one that'll be coming up and we're working on pre-leasing. I've been very surprised at the demand that we have had, especially given the beginning of the school year. This, in my opinion, in my experience, is kind of tends to be the hardest time to get families to move, because typically they've already planned to move in a new house so they can be in their school district, settle down, and be focused on their kids for September, October. So that's been, something that was surprisingly good for us on this deal. I would say that the actual kind of syndication process went much smoother than I was planning, going through all the legal docs and what have you. Still, it was a lot the first time around, but Amy Wan, Bootstrap Legal, she, was our syndication attorney for this, did a great job, made it super easy for me, helped me, fully understand the process, make sure I'm staying compliant through everything. So that's, that was really fantastic. I would say hardest thing.
So that's kind of the flip side is what did you kind of think was harder than what you'd expected originally?
Ultimately, I'm just hungry to go after the next deal. So, my sights are set forward, and I have to slow myself down and say, hey, make sure that we're getting this deal under control, that we're taking care of our investors this time around. Let's make sure we're leasing up these first couple units, that things are going as planned, that we're not going to run into any hiccups, take care of some extra, projects and what have you. I think it's my own ambition trying to to tone that back a little bit. So
Sure.
that's been a challenge. But all things considered, it's my fourth acquisition, so it was honestly probably my easiest, even though the moving parts there were certainly a lot more.
Mm-hmm. Well, Joel, I want to thank you so much for taking some time and being with us here today. You got a great story here, especially with this acquisition that we talked about on this episode, and looking forward to continuing to follow you. And how can the listeners reach out to you if they want to have some further dialogue with you, or have that conversation about possibly partnering with you on another project here in the future?
Yeah, I'm on Bigger Pockets. I'm on Facebook. You can go to my website, jfhcapital.com. So go to any of those areas and you'll be able to find me.
Well, again, Joel, thank you so much for taking your time to be with us here today. Looking forward to having you on a future episode as you close more deals.
Perfect. Hey, thanks, Dan. Take care.